The four most dangerous words in investing are this: time is different. That is a famous quote from Sir John Templeton. And in 1987, a lot of people thought this time was different. The economy looked strong, stocks kept climbing, people were making money everywhere. And when people make money for long enough, they start believing they are smarter than they really are. Sound familiar? Because we have seen this movie before, and we are seeing parts of it again today. But before we get there, let us talk about a market crash that almost nobody talks about anymore. October 19, 1987, Black Monday, the day the United States stock market fell 22.6% in a single day. Not a month, not a year, one day. It is still the largest one-day percentage drop in United States stock market history. Yet somehow, most people barely remember it. Ask someone about market crashes, and they'll probably mention 1929 or 2008, maybe even the dot-com bubble. But 1987? Almost forgotten. Which is strange, because for one terrifying day, it looked like the entire financial system was falling apart. So, what happened? To understand the crash, we need to go back a few years. Back in the early 1980s, America was on a roll. Inflation was finally coming down after years of pain. Businesses were growing, consumers were spending, confidence was returning, and Wall Street loved it. The stock market entered one of the strongest bull runs in history. From 1982 to 1987, the Dow Jones climbed from around 770 points to more than 2,700. That's more than a 250% gain. Imagine putting $10,000 into the market and watching it grow to over $35,000 in just a few years. People were excited. Money was flowing in. Everyone wanted a piece of the action. New investors entered the market. Professional investors became more aggressive. And just like every major boom in history, success created confidence. Confidence created optimism. And optimism slowly turned into greed. People began to assume that stocks would keep rising forever. After all, why wouldn't they? The economy looked healthy, corporate profits were growing, and every dip in the market seemed to recover quickly. The good times felt permanent. But underneath the surface, problems were starting to build. Interest rates were rising. The United States government was running large budget deficits. The trade deficit was growing. And some investors were beginning to worry that stocks had become too expensive. The market was not collapsing, but it was becoming fragile. Think of it like a tower built from blocks. It looks stable, it stands tall, everyone admires it. But if enough pressure builds underneath, even a small push can knock the whole thing over. That's exactly what happened. In October 1987, investors started getting nervous. Several factors hit the market at the same time. Interest rates moved higher. There were concerns about inflation, and fears were growing that economic growth might slow down. None of these issues were catastrophic by themselves, but markets don't always need a disaster to crash. Sometimes they just need fear. And in 1987, fear spread fast. Then came something new, something Wall Street had never really dealt with before: computers. Today, computerized trading is normal. Back then, it was revolutionary. One strategy became especially popular. It was called portfolio insurance. The idea sounded brilliant. If stock prices started falling, computers would automatically sell shares to reduce losses. In theory, this would protect investors. But there was one huge problem. Everybody was using the same strategy. Imagine being in a crowded stadium. Someone notices smoke. A few people start running towards the exits. Others see them running and start running too. Soon, thousands of people are sprinting at once, not because they know what is happening, but because everyone else is panicking. That's exactly what happened in 1987. Stocks started falling, computers began selling. The selling pushed prices lower. Lower prices triggered more selling, which triggered even more selling. The cycle fed itself. Fear became fuel, and the fire spread. Then came October 19, Black Monday, the day everything broke. The Dow Jones fell 508 points. Today, that number doesn't sound dramatic, but back then it represented a staggering 22.6% collapse in one day. To put that into perspective, imagine a company worth $100 billion becoming worth only $77 billion before the market closes. Imagine checking your investments in the morning, then checking again after dinner, and seeing more than 1/5 of your money gone. That's what investors experienced. Phones rang non-stop. Traders shouted across crowded trading floors. News anchors struggled to explain what was happening. Panic was everywhere. Some investors feared another Great Depression. Others believed the financial system might stop functioning entirely. Nobody knew where the bottom was. Nobody knew how bad things could get. For a brief moment, Wall Street looked completely out of control. But then something surprising happened. The world didn't end. The banking system survived. Businesses continued operating. People still went to work. The economy slowed, but it didn't collapse. And eventually, confidence returned. The market recovered. In fact, within a couple of years, many of the losses had been erased. That's one reason Black Monday is often forgotten. There was no long depression afterward, no housing collapse, no giant bank failures, no dramatic villain, just panic, pure panic. And maybe that's what makes the story so important, because it reminds us that markets are driven by human emotions, not just earnings reports, not just economic data, not just interest rates. People. People get excited. People get greedy. People become overconfident, and people panic. Those emotions haven't changed in hundreds of years. Today, we're living through another period of excitement. Artificial intelligence has captured investors' attention. A handful of giant technology companies have driven a large share of gains. Some stocks have doubled. Others have tripled. Billions of dollars are flowing into the same themes. Now, does that mean another 1987 crash is coming? No, nobody knows. History does not repeat exactly, but it does rhyme. The technology is different. The economy is different. The companies are different, but human nature remains remarkably similar. When prices rise for years, people start believing risk has disappeared. When everyone around them is making money, caution starts looking foolish. And that's usually when markets become the most dangerous. Not when fear is everywhere, when confidence is everywhere. That's the lesson of 1987. The crash was not caused by one evil person. It was not caused by one terrible event. It happened because too many people believed the same thing at the same time, that the market would keep going up forever. It didn't, and it never does. So what's the takeaway? It's not that you should panic, and it's not that you should expect a crash tomorrow. The lesson is much simpler. Stay humble, respect risk, question popular narratives, and remember that markets can change much faster than most people expect. Nobody predicted Black Monday. Nobody rang a bell at the top, and nobody knew exactly when the panic would stop. That's why the smartest investors don't try to predict every move. They prepare for uncertainty instead, because the future is always uncertain. It was uncertain in 1987, it's uncertain today, and it will be uncertain tomorrow. The people who survive are not the ones who always guess correctly. They are the ones who stay disciplined when everyone else loses their head. And sometimes the most valuable lessons in finance come from the stories nobody talks about anymore, like the crash of 1987.